Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is flexible budget with more than one cost driver. If you want a video about basics of flexible budget, we have it and it is in our video description. By the way, subscribe our channel, it's very important to us, and you will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarpin. And let's go. What is a flexible budget? Budget prepared for a different level of volume than the one originally anticipated. Then we will be able to do apple to apple comparison because we work with the budget. However, the actual volume, actual sales volume, and actual other cost drivers volumes. And why it is important. So let's consider that my sales volume budget was 100 and our actual sales was 120. Our revenues will be better, of course, because we increase it. However, it is only because of volume or something else. Our variable cost will be worse because it will increase. That's obvious. However, it is only because of volume. If we don't know that, uh, we are working with a apple to orange comparison. So we are not able to control our variance on a proper way. So we have two variance, volume or activity variance, the difference between the master budget and the flexible budget. Here is the difference based only on volume. The second one, flexible budget or revenue and spending variance. Difference between flexible budget and actual results. Here we are talking about prices, selling prices, prices of our fixed and variable cost. Other variance that is not volume based. And if we are working with more than one cost driver, uh, we need to work with the cost formulas to prepare a flexible budget. However, the variance will be the same. Let's check it in our Excel file. I want to let you know that all our Excel files, they are free to download it and it is in our video description. Here on this Excel file, we have the basic flexible budget, return on investment, and so on. We have very useful stuff here. So this is our master budget. Sales volume and number of hours. That is our cost drivers. So here we have our variance, favorable, unfavorable, and so on. So how do we do our flexible budget? For our fixed expenses, doesn't change. It is a copy and paste of our numbers here because they are fixed. The debit expense, we don't have the credit sales, so it's also a given number. However, sales revenue, $40 our selling price times our sales volume. So it is not based on hours, only on sales volume. Cost of goods sold, 12 times sales volume plus 8 times 30. We have here two cost drivers. That is what changes when we compare to only one cost drivers. We need to add all our cost drivers in our cost formula. Sales commission, only based on sales volume, $2 per unit. Shipping expense, $4 per unit. And now, our variance, they are the same, volume or activity variance. Absolute number, difference between flexible budget and master budget. And here, an if formula. If our flexible budget is greater than our master budget, we have a favorable variance because Sales volume, the higher, the better. Otherwise, we have an unfavorable variance. For number of hours, the formula is the same. However, the if formula is the opposite. The more hours we work, more unfavorable or the higher our costs are. So if our flexible budget is greater than our master budget, we have an unfavorable variance. Otherwise, we have a favorable variance. So this first formula we apply to sales and incomes. Other formulas we apply to costs. Let's paste only the formulas to make it pretty. And here the yellow ones, it doesn't make sense to work with volume variance for fixed costs. So it doesn't make sense. And here, absolute numbers, absolute difference. Here. So this is our variance, and we can also paste it here. Our variance will also be the same. Only delete these two here. What about now our flexible budget or revenue and spending variance? We have here actual less flexible budget. And the favorable or unfavorable is the same if for revenue. Actual number greater than our flexible budget, favorable variance, otherwise unfavorable variance. So here, revenue, we have a favorable variance based on volume, but also based on price. We increase our price and we increase our sales, our selling price. And here, our numbers, and for our variance here is the opposite. So for cost, if our actual cost greater than flexible budget, unfavorable variance, otherwise favorable variance. So here, oops. Oh, here we have a lot of unfavorable and contribution margin based on prices. Unfavorable variance. The prices of our variable expenses were uh, greater than the increase of price in our selling price. And for our fixed here, and when we have no variance, it doesn't matter if it's favorable or unfavorable or nothing. We keep it favorable only because of our formula. And here some favorable variance and so on. To double check if our numbers are right, when we combine flexible budget variance and volume variance, it must be the master budget variance. So here, sales revenue 200 plus 90, because they are both favorables, 290. So we can do it for all of our accounts here. Okay, guys, that's it. So thank you so much. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a nice day and God bless you.